What's going on, y'all? Welcome back to the Struggle to Strength podcast, your source for real life application on how to turn your struggles into strengths in all things mind, muscle, and money. This is a phenomenal episode. We had Nathalie Noisette, who is a financial master, like a master of mindset and money, who also left one of the best lasting words of wisdom at the end of our podcast that I think we've ever had. So we talk about a lot of things here. We talk about how to minimize your debt as much as possible, how to maximize your debt to income ratio, how to maximize your credit. We have some massive financial tools at the end of the podcast that you guys don't want to miss because they were super helpful for Travis and I. And we learned how you can basically have free money.
Yeah, there's ways that you can get free money if you have any money in an account, which is insane. I did not know.
There's a specific account that you can just put money in and then just get more money for free.
Free money?
Interest free. Not just that it's growing the account. You can take money out against it and it's interest free. This blew Travis and I's mind. So you guys probably don't want to miss this episode. We also talked about how to get ready for the recession.
Yeah.
Because that might happen.
It's happening.
It's probably, it's going to
I'm going to go on the record. It's happening.
Travis is on the record. The recession is happening. Listen to this podcast to learn how not to fall victim to it. So stay tuned. Do not miss the end of this episode. There's a lot of really good resources that you guys aren't going to want to miss. So let's all welcome Nathalie Noisette and become masters of money. I'm super excited to talk to you, Nathalie, though, because literally Travis and I, the past, I don't know how many times we've hung out, have just been talking about money.
Yeah.
How do we make more of it? How are we better about it? How do we save more of it? How do we set ourselves up for the future? So I think the majority of this podcast is really going to be us selfishly asking questions to learn how we can get better about money. And hopefully other people have the same questions that we do.
Yeah.
But I guess first, before we get started, I'd love to kind of allow you to give yourself a little bit of an introduction, who you are, how you got to where you are today. And then we'll kind of go from there.
Okay, so my name is Nathalie. I am a financial strategist, a credit expert, and I'm also the author of Converted, that little book back there. For those who are watching, and for those who aren't, the name of the book is Converted: Uncover the Hidden Strategies you need to easily achieve massive credit score success. And my journey started with a ton of accidents. And just like you guys who are students of money now, I'm still a student of money, always wanting to understand it, learn it, especially as a woman of color. I just really want to know how to earn more, keep more, really get into some of the insider conversations that we sometimes don't have access to. And that deep dive and desire to really understand how money works, not understanding I don't know what I don't know, and continuing to learn and being super curious about it has gotten me to where I am today.
I love that. I'm very interested. You mentioned how money works.
Mm-hmm.
I think that would be a good baseline understanding to start with. How does money actually work?
Okay, great question. So I'm going to take a little bit of an unconventional approach, and a lot of the things I say sound really fluffy, but I really want people to follow along and kind of really wrap your head around some of these concepts, right? Have you ever heard that health is wealth?
Mm-hmm.
Yes.
Right? But when we say that, we think eating well, we think getting enough rest, making sure we're hydrated. But that's not only what it means. Health and wealth are very closely tied to each other because of life insurance. Surprisingly, right? So, and I'm not a life insurance agent. I have no stake in the game. I'm just helping you understand these concepts, right? So first of all, let's talk about life insurance. Life insurance is not only a wealth building vehicle, it's an asset, but it's also a way to ensure that the next generation has access to money. You pass, your kids have access to funds that they would normally not be able to have access to. For example, millions of dollars worth of free money that in this lifetime they might not have access to because your pension, your Social Security, whatever money you had lying around is only available to you and not to them. So your health is also the fact that when you are in good health and you have a policy, you get better premiums. Your prices are better, right? You get access to more of a death benefit. That's one thing. There are also benefits to when you're living. There are insurance policies that offer you living benefits. So let's say you were to have a chronic disease or an illness that comes up, and that's a huge chunk of why people go into debt or have like really misfortunate financial situations, because they don't have the money to keep working and make ends meet, or they have to use credit card, they have to use loans, they have to rely on family. So when you look at all these elements, you look at your family's generational future, your financial generational future, you look at how you're able, for example, I pay $50 a month for $1 million policy, right? $50. But if I was unhealthy, granted, I'm overweight, I can lose a couple pounds. But if I was unhealthy in the sense that I had like a predisposed condition, or like diabetes or high blood pressure or something that I couldn't manage, something that I have control over, those premiums will go through the roof, right? So health is wealth. That's one way to look at money in a way and frame money in a way where you're like, okay, how can I even leverage my wellness? And once you can wrap your head around how to leverage almost every aspect of your life, you realize that money is deeply interwoven into who we are, how we exist in our existence, because health really is wealth. Another thing, let's look at money from the standpoint of, sorry, I'm drawing a blank. Let's look at money from the standpoint of credit, for example, because it's one of my favorite topics and I'm pushing the book right now. So we'll probably talk about that quite a bit. I never carry a balance, ever, but I always use my cards. And people are just like, oh, you preach that you shouldn't carry a balance, but I always see you swiping your Amex. Yeah, because it rewards me every time I use it. You understand? Like, most of my consumers, how I structure their plan, my goal with them is to get them at least $1,200 back in either value or cash a year and never carry a balance. Why would I pay, let's say I'm purchasing my book, right? Why would I pay $15.97 plus 26% interest? I don't want to do that. That's not wise. That's not a wise investment. So in addition to that, like looking how, if you really think about how you want to live your life, making sure that these credit cards are deeply interwoven into your life. I'm a traveler. I have travel rewards cards. I'm a mom. I go to the grocery store a lot. So I make sure that my Bank of America card rewards me in that way. So really just understanding how money works is understanding how you work. It's personal. How's the money going to work for you? It's not necessarily like this broad stroke thing that I'm going to say, Travis, this is how money works. And this is the gold standard. And there's nothing else that's going to matter. No, I need to know who Travis is. I need to know what Travis needs. I need to know what Travis wants. I need to know where Travis is going, where his future is, what he aspires to. And then we can work it in that way to understand how money is going to work for him.
Yeah. I think like one of the things that I'm hearing from kind of like, especially the first portion that we're talking about, is the importance of like, and health and wealth are very similar in this way. The importance of kind of like looking yourself in the mirror early on and coming to terms with the areas where you're not doing well, and making changes early, because like a lot of people, like we've had people on here who have had like testicular cancer, for instance, and they all have the same story. Like they saw that lump and they just ignored it,
Right.
And there's a weird thing in your brain with a lot of people. I have this problem where you see problems and you just don't want to accept it.
Just turn away.
Yeah. And like Josh, I'm sure you see this all the time with your financial clients, and Josh sees this all the time with the health clients. It's like, even the step of talking to you guys, those people are in like the top 1%. Most people are just like, I'm young and healthy. It's like, are you, and and it's like, I'm young and I don't necessarily need to like worry about finances, but it's like, well, that's when you need to do it. Like, that's when you need to start learning this stuff.
Get in while you're young.
Yeah.
Yes. No, for sure.
Exactly.
For sure. Yeah. Because, so a couple of things, right? One, I found out how true that is when I had my daughter. So I had her when I was pregnant with her, I was 31. And then like life just went into hyper gear, because I'm just like, okay, I really need to get my life together. I was just living for me at one point, but now I need to set her up. They would not write me a policy after the second trimester. Because that's when all the complications allegedly start, or the potential problems start, or you can pass during childbirth. So like all these little factors that because insurance companies, they have a lot of money to figure this stuff out, right? So they know. That's one thing. So speaking to the piece where people don't want to face their finances. So I have a podcast called Mental Money that addresses exactly this, the mindset piece and the money piece, because you can make all the money in the world. And we see this with lottery winners. All the money in the world does not solve your problems. It doesn't solve the internal, emotional, mental, cognitive dissonance that you might have around money, the issues that you have around money, a gambling problem that might be there somewhere lingering that you don't find out about until you have money and then now you don't. What I've found through that podcast, when I've learned through that podcast from the guests that have come on, and also from my experience as a person who used to also ignore their personal finances, we are addicted to our stress. The stress that comes up with, oh my gosh, I don't have it and I'm going to figure it out. It's almost like a risk reward kind of system. Like, okay, and I used to go through this loop all the time. It was terrible. And coming out of it, I'm just looking at myself now like, what the heck was I doing? Why was I doing that? But I would go through these periods of like feast and famine, having money, not having money. And when I didn't have it, I would almost be so proud of myself for getting out of it. But why just not get there in the first place? Right. It's this cycle. It's this mental loop that we play in our minds all the time that we become addicted to on a cellular level, that we have to learn to pattern disrupt and find a way to do it and stick to it in a way that really starts to benefit us, and we don't have those maladaptive ways of living anymore.
Yeah, it's like putting just like dollar cost averaging $5 a day into like an index fund is boring, but that will literally like change, you know, unless the country burns to the ground and everything we know like disappears, that will, I mean, you'll be set for life. Period. If you did that early on. Yeah. You literally would be a millionaire later. Like if you did that, like as early as possible. But I can see what you're saying. Like it makes more sense to people to be like, all right, you know, how do I make this happen? How do I make this happen? And it's like, you know, I'm down and then I'm up and blah, blah, blah. And yeah, I think that's like super relatable to like, that's definitely like an element of human psychology. Cause again, with fitness, that's what people do. They like gain weight and then they do these crazy diets and then they gain the weight back and they're like, no, I need to like lose it. And it's like, well, the year that you need to spend like doing the boring stuff to just get healthy, nobody wants to do that. Yeah. You know, but that's literally how you do it. Like
the boring stuff. Yeah. You're right.
Yeah. And that cortisol, like the stress that you're talking about, that cortisol addiction, like that's real. Like cortisol feels good. Like it feels good. People are addicted to it. And you don't realize that you're caught up in that pattern until someone like tells you, basically, because it's really hard to be self-aware enough to recognize that. Right. Something that I wanted to ask you about, and I know like credit is kind of one of the main things that you're focusing on right now. You mentioned that you never carry a balance, but you always use your cards. So I imagine your budgeting skills are like top notch.
A1. No one can see me in budgeting. Okay. That's a challenge. Okay.
Yeah. And especially as an entrepreneur, like if you working a 9 to 5, that's one thing. Like, I think it's really, I had no problem when I was working 9 to 5. Like I get the same amount of money coming in. Like I know what my expenses are, and you can almost just be like, look, as long as the number in my bank account isn't going down, like I know I'm not spending more money than I'm making. Yeah. As an entrepreneur, things get a lot more tricky. So I would love to hear some like tips that you have for entrepreneurs who are struggling with this, or like tips to creating a really good budget so that we can use our cards all the time, get those points, but never carry a balance. Cause that's something that I want to definitely do.
Yeah, for sure. So I had an interview once and they asked, the gentleman asked me, you know, how do I mitigate surprises, like surprise expenses in my business? I'm like, there's no such thing. How? Yeah, how? You know, that like, how would those be surprises? Maybe like variable expenses, things that might change in price, things that like, you know, maybe you didn't properly plan, because you always have to leave room for a confound, right? Things that you just, let's say you're launching something, you should create a plan. And then once you create that plan, you realize that maybe you didn't account for one thing. But that even then, that's not a surprise, because before you execute, you should know exactly step for step what that should be. So that's number one. Maybe I'm type A. Maybe that's what you'll call me after I give you this advice, right? But increase your contact points with your finances. there really shouldn't be and I'm going to say a day, really. There shouldn't be a 24-hour period where you're not checking your bank account. Mm-hmm. Why? Why not? There shouldn't, and even then set aside time during the day. Like for me, between 7 and 9, I'm in my accounts. I need to know what's coming out. I need to know if it was $7.99. Now, why is it $8.30? I really want to understand that, because it's not just about that one-off time where you see that difference. It's about how that's going to impact my expenses over a year, over 2 years, over 5 years. So those little things make a really big difference. And as an entrepreneur, another thing that you really need to understand are your key performance indicators for finances, right? If you have a product that costs 10, and I'm going to use the most simplest terms because I don't want to get into too much jargon, but if you have a product that costs $10 to produce, you're selling it for $30, you have to understand what your margins are. And then out of that $30 that you're going to be selling it for, how much of that money is going to be going towards your expenses, right? And once you look at your expenses, you need to determine how to use part of that expense every single time to not only pay the government, okay, mm-hmm. first and foremost, but second of all, how are you going to use, let's say 5% of that to make sure that you can make 20 or 30 more sales out of that little 5%. Because that's the name of the game. It's a numbers game. It's always a numbers game. So if you're not looking at the numbers, if you're not really intimate with them, like I can tell you right now how much I spend every single month in my business, but I can also almost predict how much I'm going to make because I'm really like granular about the details and the numbers. I have to know the number. You can't make decisions without the numbers. So if numbers are intimidating for you, I would say, and again, I was really kind of joking about how like no one can see me in my budget, but that wasn't always the case. I was scared of the numbers because it's just so much information. And like, I'm not someone who had the knowledge on how to really execute what it is that what my vision was. So you have to start with the smallest thing. And the smallest thing for me at one point was just not getting an SFE. Like that was the one goal. Right? So how do I not get an overdraft fee? And then you build from there. Excuse me.
I like that. And so one, I definitely don't check my bank account enough. So I'm going to start doing that.
Yeah.
But two, I created a budget for the first time for my business, like way later than I should have. Mm-hmm. Right. And holy shit, like the amount of information that you get from that. Once I just didn't know, like, I knew how to create a budget, but not to this extent.
Yeah.
Like I had someone help me. Yeah. And now I can definitively say, okay, this is why I have this cost and this is how much it makes. And this is what all my expenses are. And this is what my service costs, like all this stuff. Right. Rather than, having my older school approach of like, okay, well, I think this is what will work. So that was huge for me. I like the idea of never going 24 hours without checking your bank account. One of my mentors, Alex Ramosi, he has an Excel spreadsheet where he just checks his bank statements every single day and writes them down. So he starts to track trends. Is that kind of what you do?
Yeah, pretty much. Yeah. So I use Quicken. It's Quicken Loans.
Yeah.
They have a budgeting platform and it pulls all my bank data every single day. You can like just sync it and then it'll pull your bank data. Mm-hmm. And essentially what I do is I look at what I spend. And then if it's I separate it from fixed cost. So if it's a fixed cost, I know that's what it's always going to be. Amazon charges me $12.99 a month. I know that, right? That's not going to change unless Amazon tells me it's going to change. But then I separate the variable cost. And then out of that, there's a budget item where I will say for the variable cost, all right, so I spent $50 in gas in December. That's not the case anymore. It takes more than $50 to fill my car now. It takes about $70. So I need to account for that additional $20. And the first time I noticed that was maybe, I want to say March when gas prices started going up. Mm-hmm. The only reason I noticed it is because I budgeted $50 and then I spent $70. And then it gave me like the little red indicator that I was over my budget by $20. Mm-hmm. So you really just go in and just tack in, okay, this is how much I set for this week. If I know I'm going to be, like, for example, this week, I know I'm going to be home a lot because there's like repairs going on, I'm moving. So my budget for this week for gas was maybe $35 because it was already kind of a little bit in there. And then I'll add maybe another $15, $30 just in case. But if I go over that, I want to know how I went over. I have a transportation company in Massachusetts, and we give gas cards. I need to know, why is it that this driver is using more gas than the other driver? Are the cities they're going further? Do I need to change the budget for that? Because at the end of the year, I don't want to be looking at my profit and loss statement and see that I burned $4 or $5K in gas when I could have prevented it.
Yep. I think that's super valuable. And so do you do this every single month? Is that what you're doing?
So I do it daily and monthly. So budget, I do it once a month because they're for the most part, I can now, right? Because there's a learning curve. For the most part, I can predict how much I'm going to spend on any given thing. And then as far as like reconciling, matching what I spent versus what my actuals, like what I actually spent versus what I predicted to spend, what I anticipated I would spend, I do that once a month, and I'll adjust monthly. So if I planned on spending only $300 a month in total on groceries, this is an example. $300 is a gross misrepresentation of what I spent on groceries. But if I only plan on spending $300 a month, and that's what I budgeted for, but I actually spent like $700, I want to know why there's that $400 difference. So I'll do that every month and then adjust for the next month. Okay.
And you said you use Quicken. Are there any other ones that you recommend? I've used Mint before, but like I didn't pay attention to it enough. Like,
I was curious, like what are the top softwares that you would suggest for kind of staying on top of your finances and like automating a lot of this?
Like, I guess for beginners.
For beginners.
And that's why I smile, because I'm like, they're gonna think I'm like a sadist or something.
Well, no, because like, I mean, the person who helped me with my budget, like we're setting up QuickBooks, and I'm like, dude, this is kind of a lot. But Mint for me was like, this is super entry level. Yeah. So I'm curious, like, what are some entry level, some intermediate, some advanced type options? So
QuickBooks for businesses, non-negotiable.
Yep.
Yeah. And the reason why I say that is, even though the platform is not user friendly all that much, the customer service is phenomenal. Yeah. So like, there really is no reason why you can't really just figure it out as you go. So I would say that for a business, for a personal consumer, I'm going to say spreadsheets. Go through the pain. Go through the pain.
Did you see me panic just now?
Go through the pain. I'm gonna say it again, go through the pain, because how else do we learn? I promise you, if you go through the pain of going through spreadsheets for 3 months, and then you transition over to like something like Quicken, you're going to be so grateful that you went through the pain.
Okay.
Yeah. You understand the pain. You understand the pain of building muscles, right?
Oh yeah.
Go through the pain.
It's like, I mean, we teach people how to track their food and track macros. It's the same thing. It's like, you have to figure it out the hard way. And so, okay. So when you're doing this for your spreadsheet, what are some ways that, obviously we organize things into different categories. You might have your entertainment, your meals out, your dining, your grocery, your gas. What are the things that most people miss?
Is this for business or personal?
For personal.
Okay, that's a good question. Most people miss clothes, right? Because clothing technically falls under like meals and entertainment, but you'd be surprised how many people have things on like Afterpay, because that's fairly new, like Afterpay payments. So people miss that a lot. Another thing that people miss are like house maintenance, like lawn cutting.
For sure.
Like just things that need to be tinkered around with. Like I have to fix the garbage disposal. That's going to cost me $50. Sometimes I forget to put it in there, Subscriptions, you'd be surprised how many people are paying for subscriptions they don't even use anymore. That's a big one. I
have a number of those right now.
Yeah, I probably do too.
It stresses me out.
Yeah. And a lot of them are like $1.99 a month for some like dumb app I got 6 months ago, but
that adds up.
Yeah, it does.
Yeah. That's something that's those. I could tell you a couple of cryptos to put that into right there. So, I mean, I'm just saying, and that's okay. I'm glad you mentioned that, because that's also another thing. Like when you're burning money, you're not putting it where it could be going. So like those little things, it's small.
There's an opportunity cost.
opportunity cost. See, I don't like to use those words because people are just like, what the heck is that? And then it gets too overwhelming. But you're right. You're missing so many opportunities because everything has an opportunity cost. For example, I'm sitting here and I'm speaking to you guys, which I'm very grateful for the opportunity, pun intended, but it's taking me away from another opportunity to do something else, right?
Right.
So everything has that cost. So you should always really be balancing those two things. Like, okay, where am I right now looking at my finances and where I want to be? What opportunities am I missing because I'm paying for things that I don't even really want, need, use, things that are vanity items. Like I had a guy with a model plane collection, thousands of dollars, thousands. Okay, guys. And when he's talking about retirement, mind you, he's a little bit older. I'm like, there's an opportunity here, think about it, like really weigh what you want versus what's more important to you, retirement. So we looked into that, but for sure, getting just looking at those little details that you don't think, but when you're combing through your bank statements, you'll see those things come up, those unexpected little items that people miss that they're just like, oh my gosh, I was still paying for that.
Yeah. That's why it's important to like go through it because you're definitely losing money. What's so thinking about like a budget, how much should people be spending on different things? Like, do you, and how do you break that down? Do you have like you should be saving 10%, investing 10%? Yeah. Like, how do you look at that? How much should people spend on different things? And like, how much should we be spending on just fun, like on ourselves and just enjoying life?
Okay. Good question. So first and foremost, let's talk about debt first, right? So there's something called a debt to income ratio. And the reason why I want to attack this first is because if you are going to be trying to qualify for a home or a car or anything, this is what they'll be factoring in, whether you can actually afford it. So if you're looking at how much you make versus how much you owe, you really can get a good idea of where you are financially. So your debt to income ratio. I don't like to see debt to income ratios over 20% personally, because that's what most people need to qualify for like a home. So that's the standard for me too. So let's say you make $1,000 a month, your debt should not be more than, what's 20% of that? Your debt should not be more than $200, right? Mm-hmm. That should be, and that should be across the board. Credit cards, car loan, anything that goes on your credit report, 20%. So do the math, however that fits into your situation. As far as other things like, let's see, entertainment, I think that should be last on the list, only because if you can find a way to make sure that your debt to income ratio is low and you're still living within your means and you have about a good 50 to 60% of your income left over, then savings goals, I think you should put away at least 30% of your income, monthly income. And that's even not enough, because you should be able to have reserves for at least 6 months. I know that's a lot, especially now. And I feel bad saying it, but that's the standard, because that's about how long it takes to find another job if you were to lose one. So just to know that you have that cushion, right? And then your savings goals, if you are going to be saving, I really highly consider, again, about 30%, but that could be, you can break that down into increments. Start with $20 and then you realize you can hold on to that $20 because that might be a lot for some people. You'd be surprised. Hold on to that $20 and then add 10% from there. Add and keep a threshold for what you're going to cap it at. Let's say you cap it at $100 a week. So now you know you have $400 a month. And once you're comfortable with saving that amount of money and navigating with your new paycheck with $400 less, then you can adjust and try to save more and more and more.
I like that strategy. I think that's a lot less like overwhelming than just saying, okay, well, I'm just going to save $100 a month or $200 a month or whatever it is right off the bat, which you might be able to do, especially if you have a 9-to-5 or more consistent income. Mm-hmm. But for the entrepreneurs, I think starting small like that is definitely more helpful.
Yeah.
I do have a question on the 6-month reserve and that cushion. How do you keep that? Do you keep it in cash?
That's a good question. So no, I usually keep it in a marginal account. So that's where I would hold it. Yeah. Because
what's a marginal account?
That's a good question. So I'm just like, yeah, let's break things down. So marginal account. Okay. So for example, I have a marginal account with Charles Schwab, right? I keep the $600 in there and I invest the $600 in like one of the big four or big six or whatever. And that money is always making me money, but it's also really easy to pull out. So let's say I needed $1,000 right now, I'd probably get it in like 7 business days, right? But again, I would know I need the $1,000 in advance, at least somewhat, right? Maybe on the personal side, there might be like maybe a little unexpected thing that comes up. But if it was a business side, I'd know I need that $1,000. While you're investing that 6-month reserve, that money is making you money because it's indexing. Also, the good thing about a marginal account is that I wouldn't actually take my cash out, like the cash that I put in there. I would take a loan against the amount of money that I put into the marginal account, because let's say for whatever reason, I can't pay it back. They would just close off my investment and recoup whatever they took. But also I don't have to worry about being taxed on whatever capital gains there were from that. And like a bunch of other little like benefits from just having the money sit there. I know it's growing, but I always have access to it if I need to. And whatever company allows for a margin is who I would invest in.
Okay. So you wouldn't actually take that money out then. You said you take a loan against the money that you originally put into the account.
Yeah.
How's that work?
You literally just ask for a loan. So so let's say I have 1,000, let's say I have 4 Amazon stock and Amazon allows me to, and Amazon allows you to invest at a margin, right? Mm-hmm. Charles Schwab will allow you to take out a loan for 75% of the value of whatever you've invested. So 75% of whatever the 4 stocks are.
Okay.
The total value at that time.
Yeah. Okay.
Of that stock.
Mm-hmm.
So I literally go into the platform, the dashboard, and request a loan.
Okay. It's that easy. And now does that, because you have 100% of that cash, you're taking a 75% loan. How does that affect your debt to income ratio? Is it the 25%?
It does not.
It does not.
It does not get reported. No.
Oh, that's smart.
That would be same as like a home equity line of credit, like a HELOC. That would be similar, right?
Kind of, but not really, because if you take out a home equity line of credit, they will put that value against your actual home's value.
Right. Okay.
There's nothing to put against the value except for what I've invested.
Right.
The value that they're matching is what I've invested.
Yeah. Mm-hmm. What kind of like interest rate do they have on those? Like if I have like a brokerage, if I have like a brokerage account through like TD Ameritrade, for instance, I could take a loan out for 75% of that value and it wouldn't affect my credit.
Right.
And what would be like the interest rate on that loan?
Depending on how much you have invested, I think the threshold is like 2 or 3K. There's no interest.
No shit.
No.
All right. Next most important question. What you have a Charles Schwab.
Wait. We can't move on. Travis is so confused.
I want to know what your favorite like of these marginal accounts are.
Oh no, I use Charles Schwab. That's the only one.
Okay.
Yeah.
All right.
You said there's a cap on how much you can borrow to 2,000 to 3,000.
No, not a cap on how much you can borrow, depending on how much you actually have how much you're actually investing, how much is in your account.
Oh, okay.
Yeah, there's like a minimum, not a cap, minimum.
So you're saying if I have $100,000 in a TD Ameritrade brokerage account and I could take out a $70,000 loan at 0% interest?
And if you default on that loan, they're going to take the value of your investment.
Right. So So
that's
better than a HELOC then.
There's no risk.
Better than a HELOC.
Well, there's no risk unless you don't pay it back. Then
unless you don't pay it back. Right.
Yeah.
I mean, it's just
but then you get an interest-free loan. But then you just like.
I mean,
anyway.
Well, let's say, you just have you'll owe the difference of whatever the amount is that you took out. The same thing for a loan if you were to take a loan out on your life insurance policy. Because there are life insurance policies that build a cash value. If you default on that loan, for example, before you die, they'll just give your family the difference in the death benefit. There's no interest on it.
Okay.
Damn. I did not. I didn't know about this.
No, my brain just exploded. I
was just going to have to take, I'm having house issues and I was going to have to take out a HELOC to like pay for it, but maybe I'll just do this instead.
So I would call them, find out just how long it takes for, depending on the amount that you put in, right? And also the time for how long they'll want your investment.
Oh, I see what you're saying. That's the difference. So home equity line of credit is going to be like variable. Potentially you're paying as low as like 3 or 4% interest, but you pay it off over 30 years.
Right.
That's the advantage there. So it's like, I can take out like 30 grand and just owe like $200 a month.
Right.
And then refinance my house to pay it off. That's like the advantage there. But with this, you might have to pay it back in like a year or 2 years or something.
Something like that.
I got you. So that's better for kind of smaller amounts of money that you can pay back like quickly.
Yeah. So this is what I did when I went to purchase my home.
Still really awesome.
I took $12K out, and then I put the $12K and I use that as a deposit.
Mm-hmm. Right.
And then like I'll just save the $12K on the back end and then just put it back into the account.
Or like house hack, like rent out your house, take the $2,000 a month you'd pay on rent, pay off your loan, and then you're like balling.
I was doing Airbnb at the time, so yeah.
Yeah.
Hell yeah.
That's some like next level stuff right there.
Yeah. Travis house hacks a lot, so his brain's about to explode with all this shit right now.
Oh, wow. Travis, you're the guy we need to talk to. Okay, good.
Yeah.
Okay, good. Cameras, house hacking, I love it.
Hell yeah.
Hey, so we're coming up on the end of the episode here, but there's one question that I wanted to ask you before we go. And I don't know, if we'll have an answer for this, but are we going into a recession? And if we are, what should we do to prepare for that?
I'm not the person to ask for this.
Okay.
I'm not. I don't know if we're going into a recession or not. That's what the rumors are. That's what the streets are saying. However, we should always be prepared for a recession. So I can't answer what we can do, right? So first and foremost, if at all possible right now, try to minimize your debt as much as possible. That's going to be super important, because if the rates rise at all, you're going to be, how do I say this nicely?
Up shit's creek without a paddle.
There you go. You said it. Okay. Not me. So there's that. If you can refinance right now, like if your credit is great and you have the option to refinance, look into doing that to lower your rates for sure. Right. Try to minimize.
Can you refinance a credit card debt?
That's a good question.
Because house rates are going to be like higher right now, right? Than when we bought.
Yeah, house rates are definitely higher than when we bought.
Yeah.
Right. Refinancing doesn't really work for credit cards.
Yeah. I didn't think that was a thing. I was just wondering.
Yeah. No, I wish. But
you could theoretically get like a small loan from them or something to pay off your credit card debt and then just pay that loan at a theoretically lower rate.
If the rate is lower, like the cumulative rate is lower, because most people don't just have one card, right? If the cumulative rate is lower, yes.
Okay.
But I wouldn't really do that, because I don't want to take on more debt just to pay off debt.
Let's give it. So here's
significant sense.
I see what you're saying. Like here's a scenario that I'm thinking like that's probably pretty common. Let's say you have $50,000 in credit card debt. Yeah. I hope that nobody listening to this has that, but I bet at least one person does, because this is America.
Yeah.
So let's say you have $50,000 in credit card debt, right? Mm-hmm. And you're like, all right, I've been paying $1,000 a month in interest carrying this thing. Mm-hmm. Like that's because your interest rate is at like 15% or something. But
more like,
let's just say, but like, what's the highest a credit card could go to? Like 30%?
I think it's like 26.
26. Yeah. So like if your card can go up to 26, it's going to. So what you're paying, if we go into a recession, like it will go way up. So like you're going to owe like so much money per month just in interest on your credit card debt. It's like ridiculous.
Yeah, if those rates go up, for sure. And one thing that you can do, and this is like a last ditch effort, if you really just can't dig yourself out of that interest hole, is try to see if you can get a balance transfer card. Last resort. When I say last resort, because closing a card will drop your score, period. So transferring your balance and having an introductory period of like 12 to 24 months where you know you have no interest and you can kind of you create a plan to get ahead of it is really helpful. But if you have a card that's like 30 years old, you're losing all that age. So your score's going to drop. Yeah. But I think that's better in the long term than having to deal with like thousands of dollars of interest.
Yeah, same. Yeah. So like, if you are in a situation where you have a lot of credit card debt, we go into recession, you lose your job, the rates go up, you could transfer that to a credit card for 12 months that has no interest.
Yeah.
And at least like you won't become homeless.
Buy yourself some time.
Pretty much. Yeah. You're going to trash your credit, but you'll buy yourself some time. Yeah.
Yeah. So that's kind of like the upside.
Right. That's big.
As opposed to paying 26% over the course of the next 12 months. And who knows, that's 30 grand.
Yeah. Right.
You know?
Yeah. Yeah. And is that 26% per month, or is it annually, or no, it's like per month, right?
Yeah.
It's on the balance per month.
It's based on your balance, whatever your balance is.
So that'd be, so if it was $50,000, you would be paying $13,000 a month in interest at 26%.
No. So let's assume your balance were to remain that balance for a year.
$1,000.
Yeah, exactly. Okay. So it's based on whatever.
That's what I meant. It's divided over a year. It's not 26% per month of that. No, it's 26% annually divided over 12
whatever
months.
The balance is.
Okay.
Yeah.
So 50 grand in credit card debt though, which is like, it's insane how many people I've talked to who are like up there.
That's crazy.
No, that's
actually $1,000 a month in just interest holding that.
Right. So that's actually pretty nominal. You'll be surprised.
No shit.
Yeah. And the thing is like,
I feel better.
Don't say that. Oh my God.
I'm just playing. I'm not anywhere near close to that. But like, I don't know. I used to never carry a balance on my credit cards. And so now that I do, like, I felt terrible about it. I'm like, oh God, I'm trashing my credit. Like, what am I doing?
Yeah.
But,
yeah.
You know, I mean, well, on average, like, let's say, like, there's only 20% of consumers who have an 800 anyway. So, like, don't feel terrible. And of them, they only carry a balance between like 1% and 5% if they are going to carry a balance at all. Right. So if you can stay within that range, you'll get to like the 800 family. And I have an interest eliminator training. I give those away. I can literally give it to you. So you can drop a link in the show notes, and it shows you a product called Vertex 42. It's completely free. You plug in your credit card information, your interest rate, the name of the card, the balance that you hold, and it will show you exactly what to pay monthly. So it'll drop it down to zero, or how soon you can pay it off, and how much you'll be paying off depending on how much more you put other than like the minimum payments.
Oh, that's cool. Yeah. If you could send us that link, I would love to put that in the show notes. That'd be super helpful. Cause I feel like a lot of people are just like, oh, just throw money at it. Like,
yeah,
you know?
Yeah. But it creates a plan for you. So it's kind of like a play off of, what is his name? I don't like him very much, unfortunately. Dave Ramsey. Mm-hmm. Yeah. It's a kind of a play off of Dave Ramsey's popularized snowball method. Or the avalanche method. Different people call it different things, but you just put your information in there, and then it will give you how much to pay towards this card, how much to pay towards that card to get ahead of the interest. But you do have to, and I'm going to say this very loud and clear, because people are just like, I didn't know you had to do this. You have to allot more than your minimum payment. So let's say it says your minimum payment total is $1,000. You have to put like $1,500. Like a little bit more to get ahead of the interest. And they'll show you how soon you'll pay it off if you put that little bit more.
Mm-hmm. That makes sense. That's cool. Yeah, that'll be a really good tool. I guess last one before we take off. Any other
Guys, I'm good. I'm good on time.
Any other like must-have tools?
Must-have. Yes. So if you are a renter, you can report your rent. I have like literally a ton of. I've outlined them all in the book. Please just go get the book. I'm not going to go through them right now.
Shout out Rental Karma. That's one.
That's one. Yeah. That's like
I've worked with them. Like I've done like video marketing production for them. That's great. Their CEO is a great guy too. So I would suggest their company.
Oh, could you hook me up with them? I have no, for real. I want to be sponsored. But anyway, so I have a ton of resources in the book that will allow you to get your rent reported. That's like a big thing now, especially with rental rates going up. Take advantage of that. Like boost your score. Why not? Right. So that's definitely one thing you can do. Another thing you can do is save money while you are building your credit. So there's a company called Self. It allows you, and I'm not sponsored. I'm not paid to say this or an affiliate in any way. I still use it to this day, even though my credit's fine. Every single month that you pay them, they open a certificate of deposit on your behalf, and they pay the money you pay them into their certificate of deposit. You pay on time, you get positive payment history going for you, you get account mix going for you. And at the end of your term, they give you the option to either open a secured card for the value that you first picked, or they'll just give you the money back. So it's like you're saving money and you're building your credit at the same time.
Oh, that's cool.
Yeah. That's awesome.
Mm-hmm.
All right.
Cool.
I like that.
Yeah.
Well, cool. All right. So we've got some good financial tools then. I definitely want to see that link. Obviously, we've got the converted credit book. Shout out to that. Everybody go pick up a copy. Where can they get that? Matter of fact, like, give yourself the plug. Where can we find you? Where can we get the book? All that.
Okay. So I am Converted Credit on everything. TikTok, Twitter, Instagram. That's Converted Credit. No special spelling, just Converted Credit. Convertedcredit.com, convertedcredit.com, convertedcredit.com is where you'll find the book. I can leave, let me see something. Look in the description for a discount code and I'll give you guys 20% off of the soft cover for anyone who might be interested. And I'll give you 10% off of the ebook for anyone that's interested.
Sick. That's awesome. Thank you.
Yeah, of course.
We love saving money.
Period.
Hell yeah. Awesome. Well, Nathalie, thank you so much. We have a lot of awesome tools here, and especially towards the end, we got like really like good action items that I'm really excited about. Before we take off, can you leave us with like some like lasting words of wisdom?
Yeah, for sure. I like those.
Yeah.
So plan for the future. Even if you don't think the future is going to come, like there's so much fear mongering online right now. There was a study that was done that showed that people who saw a picture of themselves aged versus people who didn't see a picture of themselves aged, they tend to save more because they can actually visualize themselves older. So it really is in your mind. Like put yourself in a position where you want to be 30, 40, 50 years down the line, who you want to be, what you want to have, where you want to go, and start working towards that. There's so many options out there. I'm sure these gentlemen are highly intelligent. And they didn't know certain things. I didn't know certain things. I'm still learning to this day. Don't be intimidated by information and how much information there is out there. Seek, find, try. Seek, find, try. Keep trying, keep failing, fail forward, and you will be where you want to be financially for sure. Just you got to keep trying.
Wow, that might have been like one of the best lasting words of wisdom that we've had on the podcast. That was very holistic. I appreciate that.
No problem.
And I think the number one thing is like you can't be afraid to start. Like you're gonna be bad at things, and that's okay. But like we can get a little bit better every day. So I love that. I love what you got going on. I love everything that we've learned today. Thank you so much for educating us and coming on the show. Thank you, everybody who's tuned in to another episode of the Struggle to Strength podcast. We will see y'all next week.